Elon Musk is about to pull off the biggest stock market debut the world has ever seen. We're talking a $1.75 trillion price tag. That's trillion with a T. At that number, SpaceX would be worth more than every single American defense contractor combined. More than Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all stacked together. More than the entire top 10 of the London Stock Exchange. So who on earth is lining up to buy a company that loses $5 billion a year at the most expensive IPO valuation in history? The answer? You. Yeah, you heard me right. In just a few weeks, your retirement account is going to become one of the biggest buyers of SpaceX stock, whether you want it or not. And that's because NASDAQ quietly slipped in a brand new rule to make it happen. But hold on, before we get to that rule, you gotta understand why any of this matters. Because this whole thing only makes sense if SpaceX is really the company everyone thinks it is. Spoiler, it's not. Ask 10 random people what SpaceX actually sells. Most'll say rockets. A few will say Mars stuff. Both? Wrong. SpaceX isn't just a rocket company. It's actually 3 businesses jammed into one. And the rocket part? Not even the most important one. There's the good, the bad, and the ugly here. And trust me, it gets pretty ugly. So let's start with the ugly. You probably know xAI as the company that owns Twitter. Sorry, I mean X, old habits. It's also the AI lab Elon spun up back in 2023 to go toe-to-toe with OpenAI and Anthropic. And here's the wild part. A few months ago, SpaceX just bought xAI. An all-stock deal valuing the whole thing at over $1 trillion, with xAI alone tagged at $250 billion. Now you might ask, how is one of Elon's companies allowed to buy another one of Elon's companies? Honestly, I have no clue, but it happened. So with a $250 billion price tag, you'd assume xAI is rock solid, right? Or at least the people who built it are still around? Nope, neither. xAI started with 11 co-founders, heavy hitters from DeepMind, OpenAI, Google, a dream team. But by 2025, this company was torching more than $1 billion a month, and by this past March, every single one of those 11 founders had walked out the door. Then Elon himself gets on X and admits the company needs to be rebuilt from the ground up, which is a polite way of saying he just paid $250 billion for something that needs to start over from scratch. And overvalued doesn't even cover it. OpenAI pulls in around $24 billion a year, and it's worth about $850 billion. Anthropic? Over $30 billion a year, valued near $400 billion. But xAI, which maybe makes $1 billion, got bought for $250 billion. So the market's pricing xAI like it's a luxury airline. But really, it's more like a budget carrier with a broken engine. I like to think of xAI as the anti-money printer inside SpaceX. Instead of making cash, it sets the rest of the company's cash on fire. But it's just one of 3. Let's move on. This is the part everyone pictures. The rockets, the launches, satellites for the government, cargo to the space station, astronauts up for NASA. And last year, this rocket business brought in about $4 billion in revenue. Sounds huge until you put it next to a $2 trillion valuation. Then suddenly, not so impressive, especially when you realize rockets are only about a quarter of SpaceX's total revenue. So where's the real money coming from? That brings us to business number 3, the one nobody thinks about, but the one investors are obsessed with, the one actually paying all the bills. Meet Starlink, satellite internet. Basically, what if Comcast but floating in space? Sounds like something a tech bro tweets at 3 a.m., except this time, Elon actually built it. Starlink launched back in 2020. 6 years later, it's the fastest growing telecom company in human history. There are now over 10,000 Starlink satellites circling the planet, each one beaming internet down to a little dish on your roof. The dish aims itself, the satellites chat with each other, and somehow, it just works. Even Scott Galloway's a fan. He's called it one of the best products of the last few years, talked about doing podcasts from airplanes, FaceTiming his kids from 30,000 feet. A real game changer for airlines and cruise ships alike. And the numbers back him up. Starlink now has over 10 million active subscribers across roughly 150 countries. In 2025 alone, it pulled in $11.4 billion. That's about 61% of all of SpaceX's revenue. But here's the part that really blows my mind. It's not the revenue, it's the margins. 2 years ago, Starlink's profit margin was around 41%. This year, 63%. That's 20 extra points in just 2 years. The margins aren't just fat, they're getting fatter. And it's not just home internet. There's a version for ships and yachts, one for airlines, and even a classified defense version called Starshield, with contracts at the Pentagon and national intelligence agencies. So this is the real SpaceX, a satellite company that prints money, a rocket business that's doing fine but priced like it already colonized Mars, and an AI lab burning $1 billion a month. Put it all together, and here's the punchline. Starlink and the rockets made about $8 billion in profit last year. Great, right? But then XAI crashed the party. So the whole combined company lost nearly $5 billion on roughly $18.5 billion in revenue. So back to our question, who's buying SpaceX at $1.75 trillion? Still you. And this is where the real story lives. It's not about rockets. It's not about magic space satellites. It's about the financial system quietly changing the rules right before the biggest IPO ever. Because on May 1st, NASDAQ adopted something called the fast entry rule. And with SpaceX targeting a June listing, well, that timing is awfully convenient. Here's what you need to know. The NASDAQ 100 is the gold standard for tech and growth companies. There are over 200 investment funds holding more than $600 billion that automatically track that index, which means the second you're in the index, every one of those funds is forced to buy your stock. Billions in demand, instantly. Now, under the old rules, a fresh company had to wait at least 3 months before joining. That waiting period existed for a reason. It gave the market time to figure out the real price before all those funds piled in. But the new fast entry rule, it slashes that wait from 3 months to just 15 trading days. 3 months of price discovery crammed into 3 weeks. And that's not even the biggest change. There used to be a rule that at least 10% of a company's shares had to be publicly available. SpaceX is only offering 4 to 5%. Under the old rules, disqualified. Under the new ones, that minimum's gone. SpaceX walks right in. And then there's the sneaky one. Buried in the fine print is a hidden multiplier. For companies offering less than 20% to the public, NASDAQ now treats that float as 3 times bigger than it really is. So a 4% float gets counted like it's 12%. A 5% float like it's 15%. Let that sink in. They changed the listing requirements so SpaceX qualifies with barely any shares trading. They shrank the waiting period so it skips the price discovery phase. And they rewrote the math so funds have to treat SpaceX as 3 times bigger than reality. That's not natural demand. That's manufactured demand. And here's the kicker. It's not just SpaceX. OpenAI and Anthropic are eyeing their own listings too. Same setup. So NASDAQ didn't just bend the rules for one company. It bent them for a whole class of companies. SpaceX was simply first in line. So NASDAQ cleared the runway. The question is, who's getting on the plane? Most IPOs hand out 5 to 10% of shares to regular investors like you and me. SpaceX? They're targeting 30%. Their CFO literally told a room full of bankers that retail investors would be a huge part of this, bigger than any IPO in history, because, and I quote, retail buyers have been incredibly supportive of Elon for a long time. Translation, they're dumping 30% of the supply on everyday buyers. Not because it helps stability, not because of long-term alignment, but because those buyers are loyal to Elon. And here's how it all plays out. The buyers and the sellers don't show up at the same time. The buyers, that's you, get forced in early. The insiders, they sell later once their shares unlock. Stock quietly moves from insiders who got in cheap into your retirement account at peak price. One portfolio manager put it perfectly. Your 401k is the exit liquidity. Because if you own any U.S. stock index fund, then within a few weeks of this listing, you'll own SpaceX. No vote, No choice. The machinery of passive investing just buys it for you. So here's the corrected picture. SpaceX is 3 businesses that lost $5 billion last year, going public at the priciest valuation in history, and we're all about to become buyers. Not by choice, by design. And there's a reason mainstream media isn't framing it this way. SpaceX goes public at $2 trillion. That's a headline. NASDAQ quietly rewrote its rules to force passive funds into an unprofitable company. Yeah, that one doesn't exactly roll off the tongue. So if you actually want to understand what's really happening in finance, hit subscribe. Because passive investing was sold to you as the smart, easy, set it and forget it move. And most of that's true. But here's the part nobody mentioned. The same system that buys the index for you also buys whatever gets shoved into it. No questions asked, without ever asking you. And right now, somebody just squeezed their way in.